Hi everyone, it's Chad back with another video, and today I'm going to be talking about Okta that released its earnings after the market closed last night, and at the time it dropped about 5 or 6%. I actually think the earnings are pretty decent. I'm going to talk about them in a minute. Today the stock is down over 30%, 31% at the time of making this video. Could be even worse by now. Where at one point it was down more than 35%. Absolutely brutal. It seems like a down day for the market has hit this company even harder because I don't think the earnings were that bad at all. It's a cloud software company that helps companies manage and secure user authentication and also provides tools for developers to build identity control and authentication into applications. It IPO'd at just $17 in 2017, so a nice return since then. Has a 52-week high of 276. That would have been an unbelievable return from the IPO. Clearly it was a bit overvalued. It fell a significant amount. It was a price sales above 40. Then it's at a more sensible valuation of around a $10 billion market cap right now for a company that's doing over $1 billion in revenue, so still a healthy 8 times price sales or something like that. Just above its 52-week low on this 30% loss. It's a fantastic company. I'm going to tell you why. Here's a brief summary of that earnings report. Total revenue, $452 million, up 43% year over year, right in line with analyst expectations. Pretty strong growth at this sort of valuation in my opinion. Subscription revenue, which is the vast majority of the revenue and accounts for the vast majority of gross margin, up $435 million, up 44%. Total calculated net billings, up 36%. Non-GAAP gross margin, 76.8%. Plus 30 basis points. Now, I don't like to use non-GAAP metrics here, but this is all that they really disclose. Non-GAAP operating margin, loss of 3.3%. That's up 450 basis points, but still not really what we want to be seeing. Free cash flow margin declined quite dramatically, down 410 basis points to a loss of 5.3%. We'll talk about that a bit later. That is really the opposite direction I want this business to be moving in. However, given the current environment, I don't think that it's completely ridiculous to be playing aggressive essentially. Total customers up 26%. This is nice growth. 16,400 customers now, and this has been continually growing at rates in this region for a long time. Customers with account volume of greater than $100,000, 3,525. So that's around a quarter of all customers to spend over $100,000. That's up 35% year over year. 63% of the business volume is in workforce identity and 37% in customer identity. The customer identity is rapidly catching up with a growth rate of 47% compared to the workforce identity, 36%. Now these are all right in line with expectations, if not slightly above, apart from that free cash flow and operating margin, which I admit were a disappointment, but not a complete game changer for a company that's growing 40% revenue. You can see revenue has steadily climbed upwards over the last 2 years to not a ridiculous amount at any point, generally in the 30 to 40% range, but this of course adds up and compounds over the long term. And from Q1 2021 to Q2 2023, where we are now, you see it's gone from $183 million to $452 million. Now, there was an acquisition in the midst of this, a $6.5 billion acquisition, which right now is 65% of the market cap. Of course, at the time, this was a $35 billion company, $40 billion company. They used an all stock, essentially. So I'm not so concerned about that. I was all zero. And that contributed $66 million in the previous quarter. They didn't disclose how much it was this quarter. But this is not entirely organic growth for the platform. But Auth0 has been integrated into this business for a while now. And while they did mention that the integration is not going exactly as they'd like, it's still providing decent revenue for this business and is growing at a nice rate. Net dollar-based retention rate was down, but I don't think this is overly something to worry about. It's always above 120% and typically flirts 1 or 2% every quarter. A slight variation in this is nothing to be concerned about in my opinion, and this is just regular variation. It's never going to be the same every quarter, and it's very hard to increase this over the long term. So I think this is about where I'd like to see Okta over the longer term. As long as they can continually get above that 120% benchmark, that's a very happy place to be in my opinion. That combined with the organic growth of the business provides 30 to 40% growth quite reliably, or it has done over the past. One thing that may concern investors slightly is that the gross margin has steadily declined, and I say steadily, it's really not declined that much. It's gone from total gross margin around 77.5% to 76.8%. Of course, that's the total gross margin. Subscription gross margin has fell from in the last 2 years from around 82% to around 80% right now. Now, if they can put this trend and keep the gross margin in this 80% region, I'll be absolutely fine with that, the subscription gross margin that is, because this is an absolutely excellent number. Even a 76% gross margin, when you compare this to many other companies, even in the SaaS field, this is a fantastic number. Of course, there are companies with high gross margins, Adobe comes to mind, but this is an absolutely fine number for a SaaS company. For any other company, will be an absolutely staggeringly good number. So as long as they can buck this trend and keep this in the 75 to 80% region, I'll be absolutely fine with that, and this will be a tremendous company to hold over the long term. As I mentioned, quarterly free cash flow is down. The margin is a 5.3% loss, and this is kind of steadily declined from last year. Now, for a company like this that is not really trying to be super profitable, it's investing a lot back into the business, free cash flow margin is going to be all over the place. I'm kind of okay with that. This company has around $2.5 billion in cash on the balance sheet, which is around a quarter of market cap at the minute. I'm not overly concerned that this business is going to run out of cash anytime soon, and I'm quite fine with them taking a marginal loss to improve the business. And they did mention that in the previous quarter, that they're going to be aggressively investing in the business to grab market share. This is absolutely fine by me. This is the stage that Okta is at. I would like it to prove its free cash flow positivity over the longer term, but if it's not there, it's not there. This is a company that's growing 30-40% a year. That's fine by me if it can hold off on profitability a bit longer, but that will need to come and will be a concern over the longer term if this trend continues. And if, of course, this trend continues downwards in a more aggressive fashion, perhaps it posts a 10 or 15% free cash flow margin loss, then I will be very concerned. However, I don't believe this is going to be the case. I think it's going to flirt with essentially zero over the short term, and eventually they'll go to severe free cash flow positivity and nice free cash flow margins. Not overly concerned, but it's something to watch out for in the future. Now, going through that report, if you're anything like me, you've probably thought, is there any reason why this company is down 30%? Expectations weren't really sky high to begin with for a company like this. Perhaps this is the case. Now, of course, there's severe overreaction in my opinion, but the total revenue growth that they're expecting for the next quarter is not amazing. There's a bit of a reduction in growth, 32 to 33%. They're expecting 463 million to 465 million. Now, 30% growth is nothing to sniff at, but this is a company that is valued on a price sales basis at around 8 or 9. That is an objectively expensive valuation in this market, even if I don't believe that. So when you compare it with, I don't know, Campbell's Soup, a lot of investors now are looking very fearful when they see price sales and a relatively high price sales number. They hit the sell button essentially, and I don't believe this is the right thing to do. Over the rest of the fiscal year, it's still predicting 39 to 40% growth, which is an excellent number to go to be around $2 billion in revenue for the full year. They're still predicting a non-GAAP operating loss that's going to increase slightly for the next quarter, 37 to 36 million, $110 million to $105 million of loss. They have over $2 billion of cash on the balance sheet. Not concerned in this business if at this state. One of the reasons I like this business so much, which Bill mentioned, is the total addressable market. They predict the total addressable market being $80 billion, with $30 billion of that being customer identity market, and $50 billion being the total workforce packages they offer, $35 billion of that being workforce identity. This company is predicted to do just shy of $2 billion in sales this year. It is nowhere near its potential, and it's grown at 40% a year. It's going to hit some serious numbers pretty quickly and has potential to be an extremely profitable company with 70% plus gross margins. Obviously, when you see this type of TAM and you say, well, if it gets X percentage of the market, that's not really what I like to hear. However, I believe Okta is one of the strongest players in this space. It's one of the biggest names in customer identity. Anyone I speak to who has interacted with this product seems to enjoy it, much like CrowdStrike, as I was talking about yesterday. So I have only heard good things about Okta, and I believe that they can take a good share of this market as they have a great product. So overall, it's a compound annual growth rate of the last 3 years of 46%. It's going at 40% right now, which is a little bit of a deceleration, but not ridiculous by any means for a company that is maturing rapidly. It's predicted to do around $2 billion in sales at the end of the year. You know, he's putting the price sales in the 7-8 range, 8-9 range. Not objectively cheap by any means, because it's not recording profitability, but this is a business that has 16,000 customers, growing 20% a year, growing revenue of 40% a year, has a 70 to 80% gross margin, depending on what week it is, 122% net dollar retention rate. I really like this business. It has a very sticky product that I believe the industry-wide has a lot of tailwinds, and a long-term compound annual growth rate for this company in above 20% is not ridiculous in my opinion. I think it's doing a lot of things right. I like these prices over the long term. It does have a little bit of debt, around $2 billion in debt. Cash debt ratio is about 1. Not overly concerned about that. It's relatively low interest rate. It's growing 40% a year, excellent gross margins, good DB&R, strong business, large and expanding TAM. What's not to like really? Valuation isn't keeping me out of this business because I think it's got a lot more reasonable, and it's about the price I'd be happy to invest right now. So I'm going to be creating a position and adding to it slowly, dollar cost averaging over the short to medium term depending on the price action. That being said, none of this is financial advice, of course. You shouldn't just listen to me. You should do your own research and due diligence. Look at Okta, let me know what you think in the comments down below. Like and subscribe if you enjoyed the video. I'll see you again next time.